Would you like to own shares in one of the bluest blue chip companies in the world? Want to collect market smashing dividend income that's totally passive while owning those shares? Like the idea of sleeping well at night with your investments? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
I want to tell you about a high-quality stock that pays big, growing, reliable dividends. Those growing dividends are funded by growing profit because this business is an industrial powerhouse with products that touch almost every facet of life. It's never been more important than right now to invest intelligently and stick to the highest quality companies. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of 3M Company, which appear to be trading at a significant discount today. 3M Company, stock ticker MMM, is a diversified global manufacturing conglomerate. Founded in 1902, they're an $87 billion by market cap industrial behemoth that employs over 90,000 people worldwide. 3M operates across 4 business segments: safety and industrial, 36% of fiscal year 2019 sales, transportation and electronics, 30%, healthcare, 23%, consumer, 16%. Corporate and unallocated accounted for negative 5% of sales. The company focuses on applying science across 12 areas of expertise: automotive, design and construction, manufacturing, commercial solutions, electronics, mining, oil and gas, communications, energy, safety, consumer, healthcare, and transportation. Their products are used in various end applications. Think appliances, packaging, aerospace, electronics, construction, surgical supplies, telecommunications networks, and renewable energy. And they have numerous brands that convey quality and consistency both on the consumer and industrial sides. These brands include the likes of Scotch, Scotchgard, Post-it, Scotch-Brite, Ace, and the eponymous 3M. Simply put, 3M is a diversified, global, high-quality, powerhouse industrial firm. Their products touch almost every facet of life across the world. The nature of this product necessity and diversification bodes well for 3M's ability to weather all storms. And that portends good things for their dividend, which is already legendary. 3M has increased its dividend for 62 consecutive years. That's one of the most impressive track records in the world. The 10-year dividend growth rate of 10.9% is made to be even more spectacular when you consider that's coming after decades of dividend raises already. However, dividend raises over the last few years have been rather small. On the flip side, the stock's yield is quite high for this kind of quality, which is compensating new investors for some of that dividend growth deceleration. The stock yields 3.8%. That's almost twice the broader market's yield. It's also more than 100 basis points higher than the stock's own 5-year average yield. The payout ratio at 69% is slightly elevated. This will limit the firm's ability to aggressively grow the dividend for the foreseeable future, but the dividend is firmly covered. Looking at business growth, 3M grew its revenue from $26.662 billion in fiscal year 2010 to $32.136 billion in fiscal year 2019. That's a compound annual growth rate of 2.1%. It's mildly disappointing. I usually look for mid-single-digit top-line growth from a mature business like this. However, 3M has pulled some levers and made the most of this mediocre revenue growth. A small expansion in margins, along with a big buyback story, both helped to propel excess bottom-line growth. Earnings per share advanced from $5.63 to $9.10 over this period, which is a compound annual growth rate of 5.48%. Notably, I used adjusted earnings per share for fiscal year 2019. This factors out irregular but significant litigation and deconsolidation charges. Free cash flow per share and earnings per share tend to closely track each other. The adjusted numbers do more accurately reflect the true earnings power in this case. 3M compounding its earnings per share at more than double the rate of revenue growth, which is owed to the aforementioned levers. For context on the buybacks, the company reduced its outstanding share count by approximately 17% over the last decade. Looking forward, CFRA is forecasting that 3M will compound its earnings per share at an annual rate of 8% over the next 3 years. CFRA expects industrial and consumer end markets to both be weak throughout 2020 due to COVID-19, but they see demand in healthcare and personal protective equipment, also due to COVID-19, as offsetting. This forecast is down significantly from CFRA's prior 3-year earnings per share projection, which was 12%. In my view, 8% is still aggressive. I simply don't see anything in 3M's business model that would warrant a major acceleration in bottom line growth. On the other hand, I don't see anything that would warrant fears of any kind of collapse. 3M offers a very defensive business model. It's a blue chip stock. The company has historically performed well through recessions. This business won't wow you with growth, but it is the type of investment that you can sleep well at night owning. If 3M were able to continue with its bottom line status quo, which would be 5% growth annually, over the next 3 years, that would actually be pretty impressive. After all, we're in the midst of a recession as we speak. That kind of earnings per share growth would allow for like dividend growth. And pairing that dividend growth with a yield near 4% is not a bad outcome at all in this environment. Moving over to the balance sheet, I'll note that 3M used to have a fortress balance sheet. The company recently closed on an acquisition of medical products maker Acelity, Inc. for $6.7 billion, which is 3M's largest acquisition ever. The purchase was arguably too expensive and it did cause some balance sheet deterioration. That said, it added exposure to less cyclical healthcare end markets. Even after the acquisition, 3M maintains a relatively rock-solid financial position. The long-term debt-to-equity ratio, at 1.74, belies their financial strength. That ratio is elevated largely because of so much treasury stock relating back to the share repurchases. Meanwhile, the interest coverage ratio is sitting at near 14. That's a great number, indicating no financial issues. Profitability is robust, as one might expect for a blue chip. Over the last 5 years, the firm has averaged annual net margin of 15.73% and annual return on equity of 45.08%. This is a high-quality company almost across the board. It's a rare company when you think about their longevity and reverence as a business. And they're protected by durable competitive advantages like scale, brands, patents, and a large R&D platform to ensure innovation. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. As diversified as they are, a global recession will impact an industrial firm with cyclical end markets. The large Acelity Inc. acquisition adds a layer of uncertainty and execution risk while also limiting flexibility. Overall, I think 3M is a low-risk business and investment. Otherwise, they wouldn't be able to pay out growing dividends for 60-plus years. At the right valuation, this could be a fantastic long-term investment. The price-to-earnings ratio is sitting at just over 18. That's lower than the broader market. It's also favorable compared to the stock's own 5-year average PE ratio of 23.1. If we look at cash flow, we see another big disconnect. The current price-to-cash flow ratio of 12.5 is well off of the stock's own 3-year average price-to-cash flow ratio of 18.9. And the yield, as noted earlier, is significantly higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. This dividend growth rate is much lower than 3M's 10-year dividend growth rate. It's also conservative when you look at CFRA's 3-year earnings per share growth projection. However, I'm also considering the 10-year earnings per share growth rate and the elevated payout ratio. I see 3M as a very high-quality enterprise, but growth has undoubtedly slowed of late. 3M is buying growth with Acelity. As a result, the balance sheet is stretched. I'd rather err on the side of caution here. The dividend discount model analysis gives me a fair value of $178.92. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates 3M as a 3-star stock with a fair value estimate of $170. CFRA rates 3M as a 4-star buy with a 12-month target price of $177. We have a very tight consensus here. Averaging the three numbers out gives us a final valuation of $175.31, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. 3M Company is a blue chip company that provides the world with products that touch almost every facet of life. With a yield almost twice as high as the market, more than 60 consecutive years of dividend raises, a well-covered dividend, double-digit dividend growth, and the potential that shares are 13% undervalued, this could be a golden opportunity to buy this legendary name on sale. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from the same exact stocks that I own. If you think you could benefit from this as well, check the description below to see my portfolio and start getting my buy and sell alerts. I'll see you next time.